Well, here we are again, folks. Another Tuesday evening. Welcome, welcome. And good to see a number of people there in the chat already. My thoughts are with those in Victoria without power and with thunderstorms and in some cases fire. Not good there. But hope we'll find a few people from Victoria managing to find a way to watch the show as well. We'll get going in just a moment or two, and got quite a lot to get through tonight. It's just me, of course, just going through some of the latest modeling and looking at postcodes in particular. And as always, the dogs are here, of course. They went out for a walk this morning and managed to get back before it started raining, so they were quite happy about that. And of course, I have the overall studio running. No guests tonight, just me, but the same chat processes and displays with everything teed up, ready to run. And I'm monitoring the stream over there too. So everything's running well as far as I can tell from here. And as always, the delayed return from YouTube is up on my screen there, and I can see the quality of the stream looks pretty good tonight. So that's excellent. And hopefully all will go well. Anyway, I think that's enough waffling from me. So let me take the pre-show off. And then I'm going to start the show. Well, good evening and welcome to this live stream on the 13th of February 2024. Martin North here from Digital Finance Analytics. Great to see everybody in the chat, and welcome to this live stream. Today it's just me, so no guests tonight, but I will be walking through some of my modeling and, as normal, exploring some of the data that we're seeing. And of course, as always, open to take questions from the chat anytime, and I'll come to that in just a second. I will just make the point that we used AI to create this thumbnail. I've been using AI a bit recently, and it's beginning to actually help my workflow quite nicely because it enables me to do quite a lot more quickly with regard to the development of the thumbnails for the show. So that's quite fun. As with everything else, of course, there's plenty to talk about, and we'll get going in just a second. In terms of the house rules, just remind you, as I always do, that we don't provide financial advice or legal advice or property advice. This is a general conversation only on the channel here. We do moderate the chat, but encourage you to throw your questions and comments in as we go through. Please watch your conduct. We do moderate the chat, so bear that in mind. As at the 13th of February, as I said, if you'd like to get a question or get my attention, if you use that Walk the World, then I'll see it in my queue. I've got a separate queue here so I can see all the questions coming in. And I've also enabled Super Chat, which means that you can get your question top of the list or indeed make a contribution to what we do around here. And as I've said a few times, we don't do this because we're trying to make a profit. We do this because we think there's a really important conversation to be had about property and finance and all those things. So I think there's an important conversation, hence what we do. But any contribution from Super Chat is always greatly appreciated. So bear that in mind. It'd be great. Thank you very much. Right, let me get on, and I'm going to start by just looking at a few up-to-date charts. Then what I'm going to do is to do a very truncated version of the overall stress analysis that we did, and that will then take us into a conversation around mapping and also around some of the postcode level information. But as normal, the slides are quite interesting. This is the latest consumer sentiment data that came out today. Interestingly, that the Westpac Melbourne Institute showed a bit of a spike up, although of course they'd have a slightly less frequent reporting than the Roy Morgan, which showed that consumer confidence fell back down again. I think the difference is probably timing, insofar that after the RBA's conversations on Tuesday, the expectation of rate cuts got kicked out and bond yields moved up a bit, and that's continuing. So I suspect that the sentiment index from Westpac and Melbourne Institute just caught the up expectation of rate cuts, which then, of course, drifted lower. And I think probably, as I said in one of my earlier shows, it could be that we're not going to see much in the way of interest rate cuts until well into this year or even into 2025. Now, the other interesting observation here is how bullish some of the mainstream media is. So, auctions surge on rate hopes, said Larry. Well, maybe not. The national preliminary clearance rate jumped to 76% from last week's 73%. But as described many times, clearance rates doesn't really tell you very much. And then, of course, we had Carlos Cacho, chief economist at Jarden, saying, we estimate that every 0.5 percentage point reduction in the cash rate will be worth about 4% to 5% for home prices. Now, of course, expectations of home prices have continued. And we had James Kirby over at the Australian saying home buyers are ignoring the data as they rush back in with the immigration cutbacks and high interest rates put to one side by property hunters at the start of the year. So that's the sort of the positive spin. Reality, I feel, is rather different. And just on that, of course, we had the latest home price data. This is of our AMP. And you can see there that there's a little bit of sideways movement, bit of variation between Melbourne, Sydney, and the average capital. Of course, what's really happening is that we've got Melbourne underwater, we've got Sydney easing back slightly, but we've got Adelaide and Perth driving prices higher. But on the other hand, we've also got Melbourne, as I said, but also Hobart and Tasmania driving prices lower. Queensland, of course, quite positive. So it's the aggregate which is destroying perhaps a little bit of credibility about what's really going on. And, I keep coming back to this one single point. You really have to go granular. You can't just take these high-level indices and try and plot something. And I want to show you why that's important in these next few slides. So if we jump from the average high-level stories to what's really happening on the ground. Now, this is actually the 3-month variation from CoreLogic around the Sydney region, and it's color-coded. So you can see there that some of the reddy colors are down 6% or more, and some of the more bluey purpley colors are actually 6% higher or more. And you can see there's a massive range. And so even in Sydney, you can see that not all property in areas, this is houses, but we could do the same for units, it will show the same thing. Not all properties in all areas are going the same way. And that's a really, really important message. You have to go granular. And if we drop to Melbourne, it's even worse. So you can see there that the 3-month drops are even more significant. So you can see quite a few areas with 6 to 3% lower, or even more than 6%, and very few that showing considerable rises, but there are some showing small rises or indeed more significant rises. So once again, you can see that you have to grow granular. Now, if we then jump to Brisbane, well, of course, there, Brig Vegas is still going pretty well. It's pretty strong. But again, even in those areas, it's not equally strong everywhere. And you can see there that some of those areas in and around Brisbane are 6% plus over the last 3 months, but others are 0 to 3. So that just shows you again how important it is to go granular. If we then look at Adelaide, well, Adelaide prices are pretty strong, but once again, you can see that there's a few areas where it's gone slightly down, other areas where it's only slightly higher. And we go across to Perth, bit of a similar story. Interestingly, in and around the centre of Perth, the price rises are pretty low, 0 to 3%. But if you go out to some of those outer suburban areas, more significant rises from low levels, of course. And of course, in Perth, we had considerably higher prices some years ago. They dropped dramatically and are moving up. But Perth is a strong market. If we look at then Tasmania, you can see there very strong falls with considerable losses over the last 3 months. And that's continuing quite a long-term trend. So, it's always the same old. Really need to go quite granular to be able to understand what's going on. And finally, if you look at Canberra, some areas of Canberra -3 to 0, others slightly more positive, and a couple showing 6% plus. So I hope that just makes the point, as best I can, that you really need to be able to look in detail at what's going on. And these aggregate average price indices don't tell you very much at all, because of course they offset high and low moves. they, of course, also in some cases aggregate units and houses which are doing very different things. And as Edwin and I said yesterday, the other issue is that some of the zoning is pretty big. So if you look at some of the data for in and around Sydney, it's right up to Newcastle and right down to Wollongong. So that's the whole of Greater Sydney, which you could argue is probably not one market at all. So that's why I think it's important. Now, there's some other interesting data come out. So MP's properties fuel calls for change. Firstly, they showed that a lot of people, a lot of politicians have significantly higher than average property portfolios. And somewhere around 65% of all federal parliamentarians own 2 or more properties, drawing a stark contrast with the lived experience of millions of voters who rent. And of course, the other call then is to think about what might be going on. And there's a bit of a debate about negative gearing. The Greens, of course, are looking to try and get some changes to negative gearing. There is, of course, the bill in Parliament at the moment relating to Labour's Help to Buy. The Greens say the scheme will only help 0.2% of prospective home buyers and risks worsening affordability by driving up prices. But on the other hand, Chalmers has given his firmest indication yet that changes to negative gearing and CGT discounts were not on the government's agenda. But they have, of course, previously reversed course, having said one thing and then done something else. Stage 3 tax cuts spring to mind. Now, it's interesting just looking at the latest from the tax expenditures. This is from the Treasury. And it shows you that the rental deductions, in other words, the negative gearing leverage, is worth about 2.7 billion in 2021. So not dramatic, but significant. They also showed that the benefits overwhelmingly benefited the high income earners. So it's not equally spread across the population. And the capital gains discount, which applies to 50% of any nominal capital gain made by a resident, individual or trust where the asset's been owned for at least 12 months, is estimated to cost around $25 billion in foregone revenue in 22-23. And interestingly, of course, the story there is that actually CGT is a bigger impost on Treasury than the negative gearing. So that might give some people pause for thought. And if you look at how it's spread, overwhelmingly the majority of the tax benefits go to high income earners. So once again, it's really not helping the bulk of people. It's helping a relatively small proportion who are getting the massive benefits. So there's a big wealth transfer question there. And I've had the view for some time that there is need for fundamental tax reform around property. It's one of the reasons why prices have been driven up, plus migration, plus, of course, the very loose lending standards and the extended multiples. 6 times income now is, just normal. And often income is 2 full incomes rather than just 1 income. So it's really a bit of a problem. And interestingly, of course, some people have said there, and Jason says, we'll put that up actually, it's quite a good one. CGT applies to crypto as well. It does, it applies to all assets, but not at 50%, right? I think CGT would be on the full net discount value. So let's get rid of that. If I just quickly skip on, some other things that came up recently, which I thought was interesting and begins to meander into our discussion about mortgage stress. Home buyers need 6-month income to pay the median stamp duty. Of course, one of the things that happened is that Sydney home prices, for example, relative to the 90s have gone up about 14-fold, while incomes have gone up about 5-fold. So again, it's that disparity. But of course, the stamp duty bands have hardly moved at all. So essentially, it's now taking a significant amount, and they argue you need perhaps 6 months' income just to pay the stamp duty in some areas, which is probably true. It's another impost. And of course, it tends to also then slow life decisions. So, if you're thinking of down trading, then you've got to deal with some of those other issues too. And so it really is a matter of trying to deal with the stamp duty. And of course, a number of people have said, and I think there's some truth in it, that if you really wanted to think about breaking the mold, then maybe what we should be talking about is how to actually think about restructuring stamp duty, or at least lifting the bans or something, because a lot of people are delaying decisions simply because of the impost that stamp duty would hit if they were to rebuy, and of course the extended prices. Stamp duties, of course, is not uniformly spread across the country. The rates vary, but nevertheless, I think it's quite a big deal. So that for me was quite an important conversation point there. Another interesting thing which came out from Justin Fabo was to show that the cumulative interest rate changes, which is actually the mortgage rates paid by Australians, which is the blue line, continues to rise because the cheap pandemic fixed rate mortgages continue to expire. So the outstanding home loans, fixed and variable, are still rising. And you can see there how the trajectory follows, but not completely follows, the RBA cash rate. Another interesting observation is that the increase in interest rates in Australia has been especially harsh, exceeded only by Norway. Now, of course, there's a few things here. One is that in the US, you've got fixed 30-year loans. In the UK, you had a higher degree of fixed loans as well than in Australia. But you can see there that the impost on households is pretty significant. And just to give you a bit of a flavour, the average outstanding mortgage interest rate in Australia is relatively high. So we're knocking on 6% for many people. And that is still way higher than many other countries. And I think that's quite an important observation, because everything is very much in mode of higher for longer. Now, let's then quickly just go on to look at the mortgage stress as we come into that. Now, let me explain also that what I've tried to do is to short circuit some of the presentation that I'm going to give, because I also already made a show recently where I actually went through the details. So many households are in trouble. MATE is the detailed analysis of how I get to mortgage stress and what it means. I'm going to give a very short version of that tonight, but I'm not going to give a long version. I also made a show where I got postcode level information. So when I posted that first post, I invited people to come forward with postcodes. Quite a few people did, so I actually covered that in another show. And in fact, you can see I used the same thumbnail because I thought it was quite a good one. Again, AI generated. So if you want to look at that, there's about 20 or 30 postcodes where I went through that in considerable detail. Now, that said, I will just quickly give a précis of the way that I go about this. So we survey households on a regular basis. We bang it into the core market model. Core market model then allows us to look at the data multiple ways. And we can also form a view by some scenarios as to where things may be going. And that means that the mortgage stress, the price trajectory, the buying and selling intentions, the migration data, the economic data, all of that goes into the core market model. Run it through our scenarios, and then we can look at a postcode level and also rather a region or a state or an all-Australian level to be able to see where prices may go. Now, these are scenarios, as I'll discuss later. They're not predictions, they're not estimates, they're scenarios showing the sensitivity down at the postcode level. Oh, and by the way, as I'm currently very busy at the moment, I'm doing a number of one-to-one conversations with households who want an individual conversation about what things are going on in a particular suburb. I can certainly do that using my data. It's not financial advice, of course, but I can look at stress and home price trend data and other information to see what's going on. You can book a time, an hour or so conversation, either via Zoom or phone. And there is a cost involved because it actually takes quite a lot of time to do all the research. And we're booking 3 to 5 weeks out, and you can go to the blog if you want to send me a message and arrange a one-to-one conversation about a particular suburb. And interestingly, quite a few people I'm speaking with are getting quite confused by all the different conflicting signals. Are properties going up? Are they not? What will happen? So this is quite a good area where if you want to look at a specific suburb, we can do that in some detail, more detail than I can do on these shows. Now, If I go on and just talk about mortgage stress, and there are many different definitions, of course, I use 30% of income. No, you don't, because 30% of income is an artificial estimate that may have been true years ago, but is not true now. And whether it's taxable or not doesn't make much difference. So other people use underwriting metrics, but I use cash flow, money in, money out. And so if households are more outgoings, we define them as stressed. If they have a mortgage, they're mortgage stress. In renting, they're in rental stress. Interestingly, more people are coming around, I think, to that way of thinking than previously. I also look at investors with cash flow pressures, and also we can look at it at total financial stress by aggregating it across the postcode. And we can look as a percentage of households and count. Because of the rule of big numbers, the count actually gives a better view, I think. Now, the RBA showed the other week that there's a considerable spectrum between initial budget pressures, in other words, cash flow problems, morphing into mixed payments and into insolvency. And that takes time, maybe 2 to 3 years quite often. And of course, not everybody passes the trajectory from budget pressures to missing payments to insolvency. So it does vary. I measure it very early in that early budget pressure area, which is why my numbers are pretty high. But not everybody morphs into insolvency, but over time more might if rates stay higher. So here is the data, top-level data for January, and you can see there that rental stress has gone up again. It's 73.47% of all households renting. It's disastrous. And interestingly, as I showed with Edwin yesterday, if you look at the mapping, pretty much everywhere you look, rents are rising. In some cases, more than 20%. It's disgusting. Mortgage stress is also pretty high. It's above 50%, 50.5%. Compare that with 32.9% back in February 2020. And we also look at the debt-to-income ratio from the RBA. It's sort of going a bit sideways, but still higher than where it was in the early 2000s. And of course, it's artificial because only 1/3 of households with mortgages, and it includes SMEs. So it's really quite deceptive. Now, here is the top-level headline for the January run of the stress, and you can see there in yellow where it's gone up. So overall mortgage stress is higher, overall rental stress is higher, the investor stress is down a little, and the financial stress overall is aggregated down just slightly. And you can see there that New South Wales and Queensland and South Australia and Western Australia also an increase in mortgage stress. It did fall in Victoria and Tasmania and the Northern Territories and the ACT, just a little. Rental stress was strong in everywhere but the NT, Queensland and Tasmania. Investor stress, a bit mixed, and overall the financial stress was just a little lower. Another way of looking at it, of course, is by our segments, and the yellow here is just showing the hotspots rather than actually movements from last month. Young growing families, first-time buyers, of course, featuring both in mortgage stress and rental stress. The battling urban and disadvantaged fringe, very high as well in the mortgage stressed areas. In the rental stress, the most considerably exposed are actually first-generation migrants with rental stress. And you can see there that from a financial stress perspective, the battling urban and the young growing families are right at the top. And then we can look at it on a postcode basis. I'm not going to read this out in detail, but just to highlight again that right at the top of the list is Liverpool 2170 and Campbelltown. Then we go to Toowoomba and Tapping in Western Australia, the number of Victorian postcodes. Quite a lot of these areas are high growth corridors, a lot of first-time buyers, a lot of homeland packages, a lot of people who bought in right at the point when mortgages were actually at their lowest. And of course, the politicians were saying, buy now, buy now, buy now. From a rental stress perspective, central Melbourne still is up there with more than 14,000 in rental stress, but then we've got Queensland to around Toowoomba, Liverpool, Southport and Labrador in Queensland, Waterloo and Zetland, and then some of those high growth corridors. Mount Druitt appears, of course, as well, Westmead, Parramatta, Ipswich, Cranbourne, Blacktown, and then Newstead and the Fortitude Valley up in Queensland. And again, rule of big numbers, you can see that there are quite a few people in those areas struggling with rental stress. If we look at overall stressed investors, interestingly, WA is now beginning to show up as a bit of a hotspot as well as the centre of Victoria. We've got other areas like Westmead and Kellyville and Cranbourne, but also more affluent areas like Surrey Hills and Darlinghurst, where again, cost of renting has gone through the roof, as well as places like Labrador and Parramatta, and even places like Bundaberg in regional Queensland. And if we look at financial stress, which is the aggregate Postcode at the top of the list is Liverpool 2170 with 27,000 in financial stress. Toowoomba's next at 4350 with 26,500. Then Campbelltown and Hoppers Crossing in Victoria and Cranbourne and Roxburgh Park, and then the centre of Melbourne, and then Beckenham and Derrimont. And so you can see there that there's a whole tranche in Victoria, and many of those, of course, are explaining some of those selling momentum pressures that we saw. Then we come back to New South Wales and then regional areas like Ballarat and Ipswich and even Springfield. And I will just show you that we also measure default. Now, default, of course, is interesting because this is a prediction. This is looking ahead. This is trying to work out what may be happening if interest rates stay roughly where they are, or if they move up or if they move down. And what I try to do is estimate the risk of the number of people who are likely to miss payments. In other words, 30-day delinquency. And, there is a correlation, of course, between the areas here and some of the stress levels. And if you look in detail, you can see there that Cranbourne is right top of the list. Maybe not a surprise. It's a big count, more than 1,000 risk default over the next 12 months. Then we go to Mandurah in Western Australia, the area there south of Perth, where a lot of people are selling negative equity. Prices went up, then went down, and they're moving up slightly, but still a problem. And then some other Victorian postcodes where we've got those high growth corridors. Then we go to Gosford in New South Wales, and then Bundaberg in Queensland, and Toowoomba in Queensland, and then Derrimut and Point Cook in Victoria. The point there is that some of those high stressed postcodes are yet to be converted to high default levels. And that goes right back to my point about we're measuring very early stress here. So what we're trying to do is figuring out what's happening with regards to households and how they're getting by. Now, there were a little sort of relief for some people on low incomes. They got a bit of a higher lift. We've also got some people still being able to move jobs. Others are actually renegotiating, for example, their interest rates as they switch. And we still see a lot of households who are holding mortgages at much higher interest rates than they need to, but they still don't necessarily switch. They should. But a lot of renters are actually having to make hard decisions to move somewhere cheaper, maybe further out, maybe less salubrious properties, just to get by. So this is a really, really unfortunate and pretty sticky scenario. And talking of scenarios, just quickly on my current update of the scenarios. And, as I've said before, scenarios are a way of exploring different futures and to think about the consequences. None of those are predictions. Things change. And we look forward from today. Here are the three current scenarios that I run. The Goldilocks zone is that we see rates staying at 4.35% initially. They fall later in the second half of 2024. Inflation eases ahead of RBA expectations, because wages also rise a bit faster. There's no recession in Australia, and migration does remain pretty strong. So that's about the best we can hope for. The base case, which is what I think is most likely, is what I call the soft landing. So we see rates staying at 4.35% into 24. Inflation falls, but then moves a little higher later, thanks to the homegrown nature of inflation, and stays above target until 2025, which, by the way, is pretty much where the RBA is at the moment. We don't get a recession in Australia, but migration levels do fall back towards average. And the worst case, the nightmare scenario, is that we see rates going up above 4.35%, which would mean the mortgage rates will be 7% plus. And they stay high through 24, along with inflation. Unemployment starts to rise, but wages growth stalls, and we start seeing signs of a recession coming through. And then rates get cut, but probably too late. Migration drops below average. And interestingly, of course, there have been a few commentators now suggesting that we might well see the RBA lifting again before they cut. Now, that may or may not be the case. Bullock, of course, left the door completely open on that when she made her comments last week. And my observation is that she was more hawkish than many in the markets expected. The bond rates have gone a little higher. Some of the mortgage rates have moved up a little. So it's too early to say, I think, exactly how this plays out. But certainly my view is that this is a big deal. So those are the scenarios. And then if you look at what the implications of those are at an aggregate level, let me just give you Tasmania, because I think Tasmania is a really, a bit of a canary in the coal mine. This is the aggregate price scenario for Tasmania. And you can see there that the best case scenario is over the next 3 years, best case, remember, for houses, just about 1.5% higher. But if we get the base case, which for houses is what I think is most likely, there's a fall. And of course, the worst case scenario will be even more significantly down. If you look then at units, it's not quite so dramatic, but still it's pretty dramatic. So for me, I think what happens in Tasmania is worth watching, because there are a lot of people who bought and are quite leveraged. And we are seeing a number of people thinking about whether they should escape ahead of further price falls. If we then look at Queensland, a very different story. So, the scenario says, it's pretty mechanical, but if things go, best case scenario for houses, it could be higher than 15% over the next 3 years. The base case is a small fall of about 4 to 5%. The worst case, a fall of maybe 24%. And if you look at units, they don't move quite so dramatically, but still move around a bit on those three scenarios. If we then look at Western Australia, again, a very strong market at the moment, potentially a growth of 21% over the next 3 years in the best case scenario. The base case scenario would show a small rise of a couple of percent, but it would also show a fall of 18% over 3 years if things went a bit pear-shaped. And again, units move just a little less significantly. Okay, so that gives us a good basis for then having a bit of a conversation about some of the other things that are going on. What I want to do now is briefly just switch across and discuss some of the mapping that we've done. The mapping is interesting, of course, because it shows you the same information but in a rather different way. And so if we look at this is the map now. You can see here that this is Sydney, of course, and the mortgage stress count is what I'm mapping here, not the percentage. And as we pull out from the centre of Sydney, you can see there that there are a number of areas close into the city doing pretty well. But as we move up towards the yellows and the oranges and the reds, as we pull out, we start to see a rather different story. And it's a continued story, really, of, over in the west, we see some pressures on households. Liverpool 2170, as you detected earlier on from my comments, is showing significant pressure. We've also got other areas as well, Campbelltown and around there. Well, that was not surprising. That was on the list. And so you can see there that as we pull out, it's a bit of the ring of fire around the west and to the north. But closer in, it's not quite so bad. So, going back to my point about granularity, this just, again, underscores it, that granularity is important. Now, if we were then to make a comparison between that and, let's say, Brisbane, and remember I'm mapping here counts of households and the population distribution is different in Brisbane to Sydney. You can see there in and around the centre of Brisbane, the stress levels are somewhat lower, quite a lot of blues. As we pull out, you can see there that some of the other areas are a little more affected. We come out towards the Ipswich area and places like that. But the total number are a little lower because the total population is more spread out and therefore the concentrations are a little lower. If I were to map that on a percentage basis, you'd get a slightly different story. I may do that someday, but I do find that the percentages are a little bit deceptive because you can have a postcode with very low levels of population, but high levels of stress, and that would register. That is not necessarily significant compared with large numbers in other areas. So that gives you a bit of a sense of Brisbane. If we then go to Melbourne, and I'm watching Melbourne very closely because I actually think that Melbourne is a real problem child at the moment. Prices, of course, as I said earlier on, are sliding. In some areas, prices are moving down quite significantly as the mortgage stress continues to grind. But it's not, again, uniform. You can see there are some areas in and around the centre of Melbourne where things are definitely more positive. But if you move out towards the Wyndham area, 3029, or up to the north, you can see there 3064. And then if you go to the east, and that's, of course, all of those areas beyond Greater Dandenong are significant issues. And if we pull out just a little further, you can see that Ballarat comes into play as well. So my point about mortgage stress levels and where the high counts are, a lot of it is in these high growth corridors here, here, and here. But there was a lot of building going on in regional areas as well, and many of those regional areas are also in some difficulty too. Now, if we then change our view and go to Adelaide. So again, in Adelaide, you can see there that in the centre, well, there's not too much to see. And remember that in Adelaide, prices are moving up quite sharply. And in fact, affordability in Adelaide is more adverse almost than anywhere else at the moment. So incomes have not followed house prices. A lot of people who are buying in Adelaide are actually property investors from the East Coast. In some cases, I've seen people sell in Hobart some time ago and then buy in either Adelaide or Perth to try and gain more value. So you can see there that the overall counts are somewhat lower, but there are a few areas where there is some difficulty, but nowhere near the the reds and oranges that we saw in some other areas. If we then go to Perth, so this is the story in and around Perth, we can see there that the story is, a little interesting. In and around the centre of Perth, not too bad. If you start pulling out, then you start to see some of these more hotspot areas, high growth corridors, properties that are relatively new, bought off the plan. Wanneroo is a particular spot, 6065, that pops up, and then down towards Fremantle and below. And if you pull out, you can see there are a few others too. And I've said before, Rockingham, places like that also on the list. So it is not uniform, but there are some hotspots there too. I make the point that some of those areas where there's a lot of stress, home prices are still rising because there's still quite a lot of people looking to buy. So in some cases, those who are stressed can sell and get out and find a buyer. It'll be interesting to see how much longer that goes on for. And then if we go to 7,000, which is Hobart and Tasmania, again, the total counts are lower because the population density is a lot lower. But you can see there that particularly over here, there are areas around Mornington and places like that, Bellerive, and also some closer into the centre of Hobart too. So those are the current hotspots, as it were. Now, what we might do is to look at some of the other ones that we've got. Rental stress. Let's go to rental stress. I haven't done rental stress for some time as mapping. So let's start in New South Wales. And again, it's a count of rental stress. And the interesting observation here is as you look at the areas in and around Melbourne, in and around Sydney, you can see that there's some hotspots quite close in. So whilst we saw mortgage stress quite low in and around the centre, in and around the centre of Sydney, and just pulling out a bit, you can see that there are quite a few areas. Waterloo is a particular hotspot with a lot of people struggling with their rental payments. So it's a very different story compared with some of the other storylines to do with mortgage stress. That said, you can still see that Liverpool is showing up there, and Blacktown, Parramatta. So there is some correlation, but it is quite interesting to see how the maps do vary between the mortgage and rental stress. If we then went to Melbourne, again, the interesting observation is the centre of Melbourne and in and around like South Bank shows considerable amounts of rental stress. So it's a bit of a different story to the mortgage stress story. And, I do see this quite often. There is some correlation, but some differences. But as you pull out, you can start to see then that some of those similar areas like Wyndham, for example, which was there in the mortgage stress, is also in there in the rental stress as well. And as you pull out further, you can start to see places like Frankston, for example, and Casey are also showing considerable amounts of rental stress. Ballarat, not quite so much, but you can see there that there are some correlations and mappings between mortgage and rental stress, which is why overall financial stress is higher in those areas. If we go to Brisbane and do the same thing, Brisbane, of course, has seen considerable rent rises in recent times. And once again, close into the centre of town, South Brisbane, for example, and in the Fortitude Valley, you can see that there are quite a few with rental stress issues. As you pull out, you can see that the stories are quite different. And again, it is fascinating just to watch how this varies, and some correlations and some differences as we pull out. Ipswich doesn't have much of a different story, though. You see there that in Ipswich there's still a lot of rental stress as well as mortgage stress, but in other areas a little different. And I would make the point that in some areas, rental stress isn't too bad, but closer into the centre of Brisbane, where rents have gone up, it definitely is a problem. If I then go to Adelaide, the rental stress story here is, well, it's not quite so severe, but again, you can still see that remember the population density is lower here, but you can still see that in some areas in and around the centre of Adelaide and in some of those other inner suburban areas, there's still a considerable set of issues. Less so as you pull further out. The rental story is a bit different there. And if we were to look at Perth, you can see again a bit of a similar story. There is definitely rental pressure, some of it closer in, but it's a bit more patchy. Depends where you go and what you look for. But as you pull out, you can start to see that in that inner suburban ring, as it were, there's still quite a lot of people with quite big counts, and both south and north. So rental stress is definitely a thing in many areas of Perth, and in fact, rents are still going up dramatically in many areas. This block down south is particularly significant, I think, and also over if you go to Swan, even away from the coast, it's quite a lot of rental pressure. So that's the sort of the story there. The last map I want to share with you is actually the default map, because I think the default map is also quite interesting. Remember, what I'm doing here is showing you where the risk of default is higher. And so it's the same coloration. So basically, if you go to red and orange, then you are more likely to default from a number perspective. And the fascinating thing about this is that the default risks are so much higher over in the west relative to the east. You can see from Blacktown down through to Campbelltown and through Liverpool there. So the counts are definitely significant, but at the moment, the total numbers are still relatively low. And I always make the point, defaults take a long time to work through. So I wouldn't expect defaults to really start showing for another few months yet. And where they do, it'll be in the west predominantly, I think. If I then look at Melbourne, you can see there that we've got a similar story with levels of defaults. Now, there are a few areas where there's a bit of defaulting going on. Some of the stuff close in is to do with investment property rather than owner-occupied property. But as you pull out, you start to see that there's a bit of a pattern emerging. And guess what? You're starting to see that Wyndham 3029 is again there. So it seems to pop up every time. So that is a particular hotspot that I'm watching at the moment, with the risk of default rising there. We're seeing more people considering, their options, trying to refinance. But interestingly, if you go down towards Casey and Frankston, there's a really big hotspot there. And I think that's a very significant factor. And if you go across to Ballarat, again, a bit of an issue, but not as much. But you can see there are some hotspots in and around Melbourne where, in fact, the postcodes are showing risk of default over the next few months. And of course, I suppose that means that you're going to have people who are choosing to sell, needing to sell. But I would remind you, I showed you that in some of these areas, property prices were falling. So it could well be that some of those defaults lead to equity loss and other things at the end of the day. If I then go to Brisbane, the default risk is, again, because of the population distribution, relatively low. But nevertheless, you can see some counts beginning to rise. Again, it's pretty much the same old story, not too much happening close in, but if you pull out a bit, you can start to see some of the little pressure points. And, default rates, even though towards Ipswich, are not dramatic at the moment, but give it time. I think that this is probably something to watch over the next few months. So I'll be showing these maps more regularly now as we expect the default rates to continue to bubble up higher ahead. And if I then go to Adelaide, let's have a look at that. Default levels are relatively low, but again, you start to see a few areas like 5023 where the count is beginning to tick up a little. Remember, I'm projecting this over the next 12 months. So this is not today, this is over the next 12 months. But that seems to be a particular hotspot. And there are a couple of others there as you go south towards Mitchell Park and Marion, and also up to Northfield and Salisbury. And then if I go finally to Perth, now, as I've said before, Perth is an interesting one. That's Hobart. Sorry, we'll do Hobart first. Not massive number of defaults in Hobart. But I've made the point mortgage stress is definitely a bit of a problem. I'll also make the other point, the population density in and around Hobart is very, very low. So I will now do Perth. I mistyped. Right, this is Perth. So you can see here that as we pull out, there are some issues with regard to defaults. And I actually think that because of the long-term price trajectory in and around Perth and the significant rises, we are going to see more levels of default. So you can see here we've got 6107 showing as a default hotspot. Then we've got Wanneroo again, maybe no surprise because of the high stress there. Go south, down towards Cogburn, places like that. And if you come out further, again, further south, a few other areas that being shown. Mandurah, of course, as I mentioned earlier on, always shows up. That, of course, is a long-term problem. So Mandurah was created because of the run-up from 2010 to 2014 or thereabouts, and then started to fall, and it hasn't really recovered, so a lot of negative equity. So there you go. That's a little bit of a story there with regards to the distribution of stress and defaults. And, people will be able to muddle through if they can continue to hold their jobs. The question for me is what's going to happen with regard to the unemployment. And the unemployment question, of course, is a really, really big and important one. How accurate the numbers are is a really big question. There's a lot of suggestion that maybe some of the accuracy is lower than it should be. In fact, in the UK, they are admitting that the unemployment numbers are actually inaccurate and they're trying to change them and improve them. I think there are questions also in Australia as well as to whether the definition of unemployment and the way that it's calculated is completely accurate. But I come back to this point that there are households who are right up against it, but are managing to muddle through at the moment. And the expectation, of course, has been that rates will get cut quickly. If they don't get cut, then what happens? That's the key question, really. And so with all of these things, it's going to be a little interesting journey over the next little while as to what may happen. So if I then flip across to my other conversation, because we can also look at the story around the stress. And of course, I've done quite a lot of this modeling recently, so we probably won't get as many postcode requests tonight, but if you do have a particular postcode you can throw it in, and I'll get to it. But I want to just start with my favorite, which is Wollongong, because I've been looking at Wollongong for some time. And this is also a way, again, of showing you the way that the model works as well. Because, of course, the total households may be around 18,000. The really interesting thing is this mix between those owning outright, 27% here, 23% and 49%. And if you look at the stress levels, you can see there that 37% of those with a mortgage are in stress on a cash flow basis. Rental stress is at 76%, so that's a big number, more than 7,000 in rental stress in Wollongong. The financial stress overall, the aggregate is 57%. And then we can also look at the mix of property. So houses, 35%, units, 52%. And we've seen this change dramatically over the last few months and years where, in fact, more and more property has been thrown up with a high rise, and therefore the unit count has been going through the roof. Other types of property includes things like over the top of retail. The people ratio is 2, so that tells you that in some cases it's a couple or a family, others sole occupation. In fact, anything below 2 suggests that they're more solo occupants. The vacancy rate was quite high. This is from the census, 9.8%. And look at the gross investment yield. That's the return, comparing the cost of the property with the return that you get in theory if it's fully let out, so 3.4%. Net investment yield, which is after all the costs, close to 0. So many people in this area are making no cash return at all, and therefore are relying on capital appreciation or indeed negative gearing to try and cover the costs over. And if we look at the taxable income, 79,000 versus 84,000, you can see that the disposable monthly income, which is the critical measure that I look at, is about 5,600, with 43% of a disposable monthly income now going on the mortgage, 2,467, or 35.4%, 1,993 going on the typical rent. Now, these are significantly elevated, and that's why I keep saying just looking at 30% of income, either gross or after tax, as a benchmark doesn't really help. A lot of people here are well over it. And the last part of the scenario, of course, is we can then apply our scenarios, the best, base, and worst. And you can see here that in the best case scenario, well, there is still a scenario where prices could rise a little higher. But only in the best case scenario. The more likely scenario is a bit of a fall over the next 3 years. And the worst case scenario is a more significant fall. You can see that shown in the chart as well as in the table there. Units behaving quite similarly, but not quite so dramatically. A fall of 7% versus 8% for houses, and in the best case scenario, a fall of 10% versus 11%, and in the worst case scenario, a fall of 31% versus 28%. So that's the sort of scenarios that we're seeing in all of our analysis. All right, so that's given us a bit of a baseline on which we can now progress the conversation. I'm going to pop up and look at some of the chat. I've not really been following the chat from earlier on, simply because I was making all the presentations. So let me have a look. And Cookie Boy makes the point, and he's dead right, that regional property prices are definitely on struggle street. The Anti-Proof showcased this a while back. It did. And we're seeing the same. What is interesting, and I see this quite often now, there are a number of people giving up on trying to live in and around Sydney. In fact, there was a Productivity Commission report that came out that showed that people are actually now deciding just to leave Sydney, particularly younger people. And so they're looking at other states like Queensland, or what they're doing is looking at regional. The problem is that even in those regional areas, we had massive run-ups of property values. And so anybody who bought in over the last 2 or 3 years were paying very significantly higher and more elevated prices. And that hasn't really corrected itself that much. What that means is that we have a situation where the regional story is quite dramatically bad. And then you've got people in regional areas who traditionally have been able to afford to buy something now being moved and having to buy further away. So if I take Wollongong example, people are having to look south of Wollongong into Shell Harbour and places like that, into those high density estates. And even there, they have to put 2 incomes up. And even there, it's tough to get somewhere to live. So what's happening is that the story, of course, in regional is also that property prices are now not continuing to rise. They're actually going sideways or in some cases down. I did some work recently in and around the Wollongong area and also looking at Newcastle. I've also looked down and around the regional area in Victoria, and that's happening. Not true up in Queensland. So in Queensland at the moment, the drift of migrants from other parts of the country, as well as international migrants ending up there too, is sort of supporting Queensland. It's also making it quite difficult in Perth and around Adelaide. People are finding it quite difficult to be able to buy in regional areas. So this is a big deal, not least because, of course, incomes in those regional areas are way lower than closer into town. So I think, Cookie, you're onto something there. We shall continue to make some of those analyses in areas. It will take some time for this to work through. I think the thing that everybody's surprised about, what is really going on with regard to the long-term trends here, because people will muddle through, and I see this in my surveys quite a lot, that people muddle through and cut back on different types of expenditure, cut back in some cases on things like dental and other essentials, cut back on the quality of the food that they're buying, because of course they have to have somewhere to live. And because the rental sector is so badly distorted and so short of property, a lot of people with mortgages are so paranoid about maintaining that mortgage payment. Now, one of the things that they do quite often is to actually renegotiate with the bank. And the bank, at the moment, we see quite often extending the life of the mortgage. So 35-year mortgages are now a thing. Of course, that does reduce the monthly repayment a little. But of course, it extends the amount of interest that's paid over time. And we're seeing more people now moving into retirement with mortgages, which means that you're kicking the can down the road. Now, if you have an expectation that this is a short-term blip and rates are going to come down and incomes are going to rise and everything's going to be marvelous, then fine. But I suspect that we're going to find that interest rates will be high for longer. The growth rate for many people in terms of incomes is going to be rather subdued. I think the cost of living will continue to rise because I think the inflation pressures are still quite strong there. And as a result of all that, it's going to be a very uncomfortable ride for quite some time. And, the more you look at it, the more you think about, what may happen is going to be unpredictable. Now, Leighton asked for a postcode, 4650. So let's look at 4650. Okay, 4650. Which is in the Wide Bay Burnett area, and it includes quite a lot of areas in the SA3 of Maryborough. So here you can see 14,000 households. We've got 45% owning outright, 30% borrowing, and 24% renting. We've got half of borrowers with mortgages in mortgage stress. We've got 34% of renters in rental stress. We've got some stressed investors, and overall, the financial stress metric is about 27%. So it's not massive, but enough to be a concern. 90% of properties in the area are, of course, houses, small number of units and other types of property. People ratio is just above 2. The vacancy rate was pretty high when the census was done, 10.5%. So that might be some second homes and holiday homes there in the area as well. The gross investment yield was 4.3%. The net investment yield is 0.3%. The average taxable was reported by the ATO at 63,000, whereas the census for the household said 53. It's unusual to find it lower, but in some cases, that is what the ATO is reporting. I suspect that was to do with where people were on census night. Anyhow, the disposable monthly income is around 3,496. Which gives an average mortgage repayment of about 1,380 or 39.5%, and an average rent at 1,271 or 36.4% of disposable monthly income. So pretty high, but not the highest that I've ever seen. Look at the scenarios. Because of the demand, not only in and around Brisbane, but more broadly across Queensland with the high migration, the best case scenario would show further rises of prices over the next 3 years. If things went really well, 17%. The base case shows a fall of a couple of percent. The worst case for houses, a fall of 23%. So again, these are sensitivities. This is not meant to be a prediction. If you look at units, up 14% over 3 years, down about 2.5%. The worst case, down 20%, is what we're seeing there in that particular postcode. And in fact, I did a show some time ago, I think, when I looked specifically at Maryborough. One of the things I highlighted here is the question of flooding. And of course, there's been a lot of flooding in a lot of these areas. So that's one of the other factors to bear in mind, is that flooding is potentially going to mess with some of the values in some of the areas. All right, let's find another one to look at. what's happened there. Let's see if I can pick that one up. My chat's stopped. Where's my chat stopped? No, it hasn't. There you go. Yeah, sorry, I'm getting myself confused. Can I please bring up postcode 2200? Sure can. I was looking at my wrong screen. I've got too many screens open on here tonight. This is in Bankston in Condell Park. I'm going to take you off screen so you can see the full results. Okay, so the first thing to say in this postcode, it's in the Canterbury SA3 area, 15,000 households, 25% own outright, 28% are borrowing, 46% are renting. You can see there that mortgage stress is 25% of households, just over 1,000, but there's a very high count of rental stress, 89%. And overall financial stress is 58%. The mix of property, 38% houses, 44% units, and 16% other types of property. The people ratio is quite high, so that's a number of households as well as individuals, I think. Vacancy rate was 8.8%, which is quite high. The gross investment yield at 3.4%. Net investment yield is negative, minus 0.5%, minus 0.5%. And the point about this is that we see this quite often in some of these areas where, in fact, now the rental is not sufficient to cover the costs of the property after allowing for the management fees and other things that rental property owners need to think about. Repairs as well, of course. Looking at the data, 63,000 from the ATO per individual. This is in tax year 2021. We'll get the next update quite soon now, and we'll incorporate that later. The household census said 72,000, and where the census is higher, this often is an indication of multiple mortgage holders and multiple salaries going to pay the mortgage. Looking at the disposable monthly income, that comes out about $4,200 a month, and 50.2% on average, or 2,368, going on the average mortgage repayment, or 43% going on the average rent of just over $2,000. And looking at the scenarios, well, the best case scenario, there is a path to higher prices if things go really well, 8% higher over 3 years, but the base case is a fall, about 12% over 3 years. The worst case, down 32%. For units, up 6.8%, base of down 10%, and the worst down 27.6%. Okay, Rob said, can you please do 7250? All of a sudden, yep, give that one a go. Okay, and again, what I'm going to do is take you away so you can see their full sheet. All right, so this is 21,800 households with 36% owning outright, a third borrowing, and 30% renting. You can see there that mortgage stress isn't really a thing in this particular postcode, but rental stress is extremely high. Now, I should say, it says 100%, that's plus or minus a few percent because the sample rate is always grossed up, so there's a bit of leeway there, but a lot of people are in rental stress. Overall financial stress, not dramatic, 31%. Mostly houses, 81%. Some units, 10%, and other types of property. The people ratio is quite high, so that suggests some families. And the vacancy rate, 7%. Gross investment yield at 5.2%. Net investment yield is flat, 0. And the taxable income from the ATO at 74,000 and from the census at 72,000, very much a line ball, which gives a disposable monthly of about $5,500, which is 28% going on the mortgage, 1,560, or 25% going on the average rent at 1,420. And looking at the scenarios, well, the best case scenario would be a very small rise over the next 3 years. The base case will be a fall of about 18% over 3 years, and the worst case, down 38% for houses, a little less for units, but pretty close. And as I've said before, I think Tasmania is quite interesting, just watching what's going on there. All right, let's see whether we can find any other postcodes that people are after. Just bear with me as I... Alison said I was in 4101. Let's look at 4101, shall we? 4101. Tent cities. So this is Highgate Hill, and in Brisbane, of course. And we've got 15,000 households with 62% renting. Wow, that doesn't surprise me in about 10 cities. And you can see here that we've got a lot of mortgage stress, 78%, 81% of renters in rental stress, stressed investors. We've got wall-to-wall problems and 81% of households in financial stress. That's a big deal. You can also see that most of its units, 79%, small number of houses. People ratio is quite a lot lower, so there'll be a lot of sole occupiers as well as a few families. Vacancy rate was very high at 15%. Interestingly, the gross investment yield is 5.3%, the net investment yield is positive 1.5%, and the taxable income's around $100,000, slightly under from the ATO, slightly over from the census. On the disposable monthly income, $6,993, so $7,000 on average, with 34.8% going on the typical mortgage and 32% going on the typical rent. And from a scenario perspective, best case scenario, a small rise, but the base case, a bit of a fall, 16%, and the worst case down considerably. And again, units a little less dynamic than houses, which is often what we see. Okay, just skipping down, see what else I can see. Okay, Sasha says, can I do 6743? Certainly can. 6743. So this is Durack in the district of Kalgoorlie. Get rid of that. Now, I would make the point, this is a low count. So, take this with a little pinch of salt because, of course, the sampling rate is, I've got a 1% sample, so it's just a little bit cautious when we get to these low count indicators. But what we do see is a lot of people renting, 66%. Small number own outright, some are borrowing. Half of those with a mortgage are in mortgage stress. 25% of renters are in rental stress. And overall financial stress around 31%. 65% of houses, 6.4% of units, and the rest are other types of properties. High vacancy rates, I noticed, 19.1%, 2.29 ratio, so some families as well as individuals. And this is astonishing. Gross investment yield, 3.4%. Net investment yield minus 2.9%. So it's very, very low, which explains probably the combination of what rents can be commanded versus the cost of property. The average taxable was $78,000 from the ATO and $102,000 from the census. So, you'd think that some of the mortgage payers have two incomes coming in. And the disposable monthly on average about $7,300, with 32% going on the average mortgage repayment, $2,400, and the rent is lower at $1,200. And I think that's an interesting observation. Quite a lot of households are unable to pay more because they don't earn enough to be able to pay the rent. So that's the story there. Looking at the price scenarios, because of what's happening in Western Australia and the low levels of stress here, there is still some upside potentially for prices. Best case scenario, maybe 20%. That could be a bit aggressive, but that's what it says. Base case, pretty much flat. Worst case, a fall, and units a little less so. Okay, let's have another look at another one here. I'd like to hear 4509 North Lakes. Sure, we can do that. There we go, 4509 North Lakes. And here we have 13,000 households with 14.3% owning outright, 43% borrowing and 42% renting. 43% borrowing, that's a high number, isn't it? 23% in mortgage stress, 83% in rental stress, and overall financial just above 50%, 56%. 79% of houses, small number of units, other types of property there. People ratio is quite high, so some families. And the vacancy rate's low at 4.4%. Gross investment yield is 4.5%, net investment yield 0.5%. Average taxable, 75,000 from the ATO and 109,000 from the census. Again, multiple incomes going to pay the mortgage. Disposable monthly income, 6,600, with 36% going on the average mortgage at 2,398, and the average rent at 30.9, at just over $2,000. And looking at the scenarios, best case scenario, a bit of a rise over 3 years. The base case, a fall of 8%, and worst case, 28% for houses, a bit lower for units. So Drew, the Chinese selling, yet with all the new Australian government laws about keeping the place empty, even if they're cashed up. Yeah. I think we discussed this recently on Edwin's show, that we know that there are a lot of people getting out of investment properties in Melbourne for those reasons. This is actually the story in the postcode at 3,000. And you can see there 23,000 with 10% owning outright, 11% borrowing, and 77% renting. So a lot of rental property, 78% in rental stress. A lot of stressed investors are looking at it from the other side. And so that's the reason why a lot of people are actually choosing to sell their investment properties in and around Melbourne. That's why listings have risen. And if you look at it, you can see there that the overall story is all units, 99.1%, a small number of other types, particularly, I guess, over retail. The vacancy rate's very low. The vacancy rate, 32%, extremely high. So a lot of it's empty. And that's one of the questions we've got. Why is so much property empty? A lot of investors, of course, holding property empty, including Chinese investors. People ratio is very low. So a lot of sole occupancy. And the gross investment yield is 4.1. Net investment yield is 0.5. So it's just positive, but hardly anything at all. And if you look at the taxable income, 81,000 for the individual versus 67 for the household. And you can see there that that gives a disposable monthly around 4,849, with 42% going on the mortgage, more than $2,000, but 38% at 1,843 going on the average rent, which is very high relative to income, 38%. And so, unfortunately, the scenarios are showing that even in the best case scenario, prices are going to fall. There you go. That's the reason why it is that we would expect to see more properties listing in and around the centre of Melbourne. Cookie Boy's disappeared. See you, Cookie. Thank you for your time tonight. Okay, Quinn says 2262. Can do that. This is Blue Haven up in the Central Coast. And here we've got, I'm just going to take you off so you can see the full thing. There you go. 8,500 households, 35% own outright, 36% of borrowing and 27% of renting. Mortgage stress at 36%, but rental stress at 88%, very high. Overall financial stress, 45%. 94% of houses, small number of units, other types of property. People ratio is quite high, so that would include some more mature families and kids and what have you. Vacancy rate's also quite high. The second homes, Airbnb, possibly 7.4%. Gross investment yield 3.4%, net investment yield minus 0.2%. And you can see there that there's not a massive difference, 64 versus 70 for the census versus the ATO. Gives a disposal monthly of about 4,500, with 46% going on the typical mortgage, just over $2,000, and rent 42% at $1,900. And looking at the scenarios, best case scenario, a rise of 8% over 3 years, the base case a fall of 12%, and the worst case a fall of 32% for units, a little less compressed. Okay, another question coming up here. 4870. Okay, far north, Cairns, south, including Westcourt, Whitfield, and Cairns. I'll take that off so you can see the full thing. 28,000 households, 24% owning outright, 32% borrowing, and 42% renting. We have 38% in mortgage stress, 34% in rental stress, small number of stressed investors, and overall financial stress, 29%. So it's quite a lot lower in this area relative to some. Nearly 60% to houses, 25% to units and other types of property. People ratio is 2.11, so it's a little bit higher than some of the ones we've seen. 10.7% vacancy rates. That probably includes some second homes and Airbnb, etc. Gross investment yield 4.3, net investment yield positive, just 0.2%. The taxable income's around $75,000 from those two data points, and that gives a disposal monthly around $5,000, with 37% going on a typical mortgage at 1920, or rent 29% going at 1544. From a scenario perspective, positive in the best case scenario of 18% over 3 years, the base case a small fall, and the worst case a considerable fall, slightly less for units. Okay, Shane says 3978. So this is Cardinia and Clyde in Victoria, in the Latrobe area. And here we have 13,000 households with just 8% owning outright, 68% are borrowing, that's the highest I've seen tonight, 23% renting. Mortgage stress, not bad, 4.4%, but 50% of renters in rental stress and a bit of stressed investors, but overall financial stress is relatively low. It's mostly houses, 97%. People ratio is extremely high, so this is a lot of families, 3.12. And you can see that the vacancy rate is extremely low in this area. You can also see that the gross investment yield is 3.3, the net investment yield is minus 0.6. Now the taxable income is 69,000 versus 112,000 from the census. So you can see there are two incomes absolutely going to pay those mortgages, which gives a disposal monthly of around $5,600, with 46% going on the average mortgage at $2,600 and 35% going on the average rent of around $2,000. From a scenario perspective, maybe 6% over 3 years in the best case scenario, but a fall of 13% in the base case or 33% in the worst case. Units a little less severe. Okay. What else have we got? Okay, Drew says 3065. Okay, 3065, which includes a Fitzroy in the Yarra. 4,800 with 17.5% owning outright, 21% are borrowing, but 61% are renting. 64% in mortgage stress, 65% in rental stress, overall financial stress is 62%, that's high. Mostly units, 59%, or other types of property at 37%, only 3.2% are houses. Vacancy rate's extremely high at 18.8%. Wonder whether that could be students or something like that. We have a low household ratio as well, so that would individual people. Gross investment yield 3.8. Net investment yield 0.5. Average taxable, excuse me, I've got hiccups, excuse me. Average taxable 106 versus 114. I took a bit of a swig of water and it's gone down the wrong way. My apologies. Disposal monthly is 7,805 with 38% or $3,000 going on a typical mortgage and 28% going on a typical rent. And if I look at the scenarios, even the best case scenario, a bit of a fall, worst case scenario, a significant fall, and units following suit. Caleb says 6025. So this is Craigie in Western Australia, in Joondalup. 12,000 households, 37% owning outright, 46% borrowing, and 16% renting. And if we then look at the stress levels, 32% in mortgage stress, 70% in rental stress, overall financial stress 31%, 89% for houses, small number of other types as well. People ratios 2.42, so that's again, more than individuals, that's families. 5.8% vacancy, 4% gross investment yield, 0.3% net investment yield. The taxable was 91 from the ATO for individuals, 109 for the household. And that gives a disposal monthly around 6,200 with 38.5% or 2,400 going on the mortgage and 32%, 1,993 going on the typical rent. And looking at the price scenarios, best case scenario, up 18%, base case down just a little, worst case down 21%, units up 16, down 18, or just slightly down, depending on what you see. Jason, thank you very much for the super chat, and appreciate all of the support that you provide. It really is appreciated. And I can also do 3194 for you. And as Jason says, please like the show. It really does help to spread the word. And this is an important conversation, I think. So, all right. So in Mentone, which of course is in Kingston Inner South, 6,000 households, 32% own outright, 35% are borrowing, 32% are renting. Mortgage stress at 19 is pretty low, but rental stress at 86 is pretty high. Overall financial stress is 42%. 44% are houses, 18% are units, quite a lot of other types of property there too. The people ratio is above 2 and the vacancy rate's at 9. Gross investment yield is 3.2. Net investment yield is minus 0.8%. I see that a lot of the inner suburban ones in and around Melbourne with negative returns. About 60% of people in the Greater Melbourne area with investment property are underwater. 89 and 99 on the income. And looking at disposable monthly income, around 5,800, with 44% going on the typical mortgage, 2,600, or 33%, 1,954 going on the typical rent. And from a scenario perspective, even the best case scenario, it's a bit of a fall. It's just a question of how severe the fall is, and that's true both for units and for houses. Okay, Lily said 5700. Yep, we can just squeeze that in. I'm running out of time now. So Port Augusta in, of course, outback Australia, or in South Australia, in the federal seat of Grey, in the LGA of Port Augusta. And this is, of course, a really interesting scenario here. 4621 is the households, 31% own outright, 25% of borrowing and 43% of renting. A lot of mortgage stress, 92%. A lot of rental stress, 77%. A lot of financial stress at 62%. And overall, 77% of houses, 8% to units and other types of property at 14.6%. 1.83, so that would suggest some individuals as well as families. Very high vacancy rate at 18.7%. The gross investment yield is 3.8. Net investment yield is 0. And the taxable income is around 69 or 62, depending on which of the sources you use, giving an income on the disposal monthly basis of around 4,300, with 30% going on the typical mortgage at 1,300, or 23% at 997 going on the typical rent. Looking at scenarios, best case scenario, positive 6.1% over 3 years, base case down 13%, or worst case down 34%, and a little less for units. All right, well, I think that's probably where I'm going to leave the story for postcodes, and just flip back to the other part of the presentation, and I'll close out the show. I've made the point, I think, quite a few times that, there's a lot going on here, and quite a lot of the stories are really not necessarily getting into the heart of what's really going on. But I've tried to do that, and I think it's clear to me that you can see how this plays out with regard to financial stress, double incomes, high growth corridors, all of those things. And it's not going to play out positively, I think, ahead. I just don't see how the government is going to pull levers to make it positive. So what I really think it comes down to is households, to an extent that they can, need to grasp their own finances. Many households don't have cash flows, don't understand where the money is coming in and going out. So that's the first thing. It's really important to understand that. It's also very important to get the right help. And I think I may have mentioned this, I will say it again, that the truth is, of course, that the debt helpline, 1-800-007-007, is a very important source of help for many people. It's government supported. And the danger is, if you're not careful and you Google help, you can end up speaking to people who will charge you to try and, quote, advise you, which is really bad. This one won't. This one actually will provide good advice. So if you are in financial pressure, I would recommend the National Debt Helpline, 1-800-007-007. And they have experts who can help. As I said earlier on, the problem is that sometimes the banks will do what's in the bank's interest, not necessarily in the household's interest. So it is quite important. And so I do recommend the National Debt Helpline, and caution against some of the other sources of, quote, help, unquote, which are, in theory at least, available via the internet. Of course, if you want more information about what we do, the dog's just going to give me a shove and move the microphone. You can always go to the DFA blog, which contains a lot more information about what we do. If you want to get access to the information that you've seen today, we do actually have a Patreon program where you can support us, and we have a number of supporters. Thank you very much for those who do support us. Feel free to go sign up at the level that's appropriate for you. But if you want to get hold of the data set, which I'll be sending out to all of my supporters who are subscribed at this level tomorrow now, it's $50 plus GST a month. And that gives you access to the information for the 2,000 postcodes that we actually have. And I'll make the point that the point of that is that you can then manipulate the data and get in behind the scenes much more than I can do in a show of this length. So that's how you get access to it, if you indeed feel that you would like to have access to even more information about what's going on. And I will just mention, of course, that we do also have a PayPal feed. So if you'd like to support what we do here, there is a way of doing that, and it is greatly appreciated. It does help us to cover some of the costs. There are costs involved in doing this stuff and doing all the research, and so we do appreciate all the help we get from that as well. Now, just to say that next week we've got Chris Bates coming on. Chris Bates, mortgage broker based in Sydney. And so he's going to be talking about what he's seeing with regard to property prices. And I want to really probe him on some of the underwriting stuff that's going on at the moment, because there are some really, really weird things going on there. And the following week, Adam Stokes is going to come on and talk about crypto again. And we're going to talk about the price of Bitcoin. It's just above 50 at the moment, the halving that's coming up, and also more broadly, the alternative finance story, which is still emerging and developing. So that'll be quite interesting. Anyway, I think that's pretty much what we're going to cover tonight. I hope you found that useful and informative. The dogs are a bit of a problem insofar that we've got Luna, who's there. But I've got Meteor here. So what I might do, if you're still with me, come here, Meteor. Oh, there we go. So Meteor is now giving a bit of an... There you go. Good girl. So this is Meteor. She's ready for her lunch, which is why she's come to give me a bit of a proo, bit of a prod, bit of a sniff, bit of a nudge. There you go. There you go. So that's Meteor. Anyway, I want to say thank you very much for watching the show tonight. I hope you found this useful and informative, and I will look forward to seeing you next week. And Drew, so far as I know, according to here, everything is fine. So if there's a problem with the stream, I fear it might be at your end. This is Martin North and Meteor signing off. We'll look forward to seeing you next time. Cheerio. Yes, it's a Kelpie. It's a Kelpie cross, actually. A cross between a Kelpie and a Border Collie. That's why it's got a white one. The other one down there The other one down there is a full Kelpie. So there you go. Martin North from Digital Finance Analytics, signing off with Dog. Take care. Have a good week. See you next time.